My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Analytics as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is Payback period. The payback period is the time it takes for a project or investment to recover its initial cost from the cash inflows it generates. In simple words, it tells you how many years or months it will take to get back your invested money. Why is payback period important? It helps businesses quickly know how fast they will recover their investment. Shorter payback means less risk because money is recovered sooner. It's a simple and popular method for quick decisions. How to calculate payback period? Add up the cash inflows year by year until the total equals the initial investment. Example: you invest 50,000 rupees in a machine. It generates Year 1, 15,000 rupees. Year 2, 20,000 rupees. Year 3, 20,000 rupees. Add year 1 plus year 2 is equal to 35,000 rupees, still less than 50,000 rupees. Add year 3 is equal to 55,000 rupees, crosses 50,000 rupees. Payback period is equal to 2 years plus 15,000 rupees remaining divided by 20,000 rupees in year 3 is equal to 2.75 years. Easy tip to remember. Payback period is equal to time to break even on investment. The faster you get your money back, the safer the project. Simple, quick, and handy for first checks. Next important short question is 2. Accounting rate of return. Accounting rate of return ARR. The accounting rate of return ARR shows how much profit a project will make compared to the initial investment using accounting profits, not cash flows. It's expressed as a percentage. Why is ARR important? It helps businesses quickly understand the expected profitability of a project. Easy to calculate from financial statements without complex formulas. Good for comparing different projects. How to calculate ARR? ARR is equal to average annual profit initial investment times 100. Average annual profit is equal to total profit over project life divided by number of years. Example: you invest 1 lakh rupees in a project expected to give 30,000 rupee profit per year for 5 years. ARR is equal to 30,000 rupees 1 lakh rupees times 100 is equal to 30%. This means the project will earn 30% of the invested amount as profit each year. Easy tip to remember. ARR is equal to profit divided by investment times 100. It tells you how much return, profit, you get each year from your investment using accounting numbers. Simple and useful for quick decisions. Next important short question is 3. Profitability Index PI. The Profitability Index PI shows the value created per rupee invested in a project. It helps you know if a project is worth investing in by comparing the present value of future cash inflows to the initial investment. Why is PI important? Helps in ranking projects when you have limited funds. A simple way to see if a project adds value. If PI 1, project is profitable. If PI 1, it's not. How to calculate PI? PI is equal to present value of future cash inflows initial investment. Example: you invest 1 lakh rupees in a project. The present value, PV, of future cash inflows is 1,20,000 rupees. I is equal to 1,20,000 rupees 1 lakh rupees is equal to 1.2. Since pi is 1.21, this project is profitable and creates value. Easy tip to remember. I is equal to value you get divided by money you spend. If the result is more than 1, invest. It's a quick test for project worthiness. Simple, smart, and handy. Next important short question is 4. Decision tree. A decision tree is a visual tool that helps businesses make complex decisions step by step. It shows different possible outcomes, chances, probabilities, and results, profits or losses, for each choice. Why is decision tree important? Helps analyze risks and rewards before investing. Shows all possible paths and their financial impact. Makes decision-making easier by breaking big problems into small steps. How does it work? Start with a decision point like invest or not. Draw branches for each possible outcome, success, failure, etc. Assign probabilities and payoffs to each outcome. Calculate expected values to find the best option. Example. You plan to launch a new product. Success, 60% chance, is equal to 2 lakhs rupee profit. Failure, 40% chance, is equal to 50,000 rupee loss. Expected value is equal to 0.6 times 2 lakhs plus 0.4 times minus 50,000 is equal to 1 lakh 20,000 rupees to 20,000 rupees is equal to 1 lakh rupees. Since the expected profit is 1 lakh rupees, it may be a good investment. Easy tip to remember. Decision tree is equal to map your choices plus outcomes plus chances. It helps you pick the smartest path in uncertainty. Visual, simple, and very useful. Next important short question is 5. Cost of capital. Cost of capital is the minimum return a company must earn to satisfy its investors or lenders. It's like the price a company pays to raise money, through debt or equity, for its projects. Why is cost of capital important? It helps decide if a project is worth investing in. Projects should earn more than the cost of capital to create value. Acts as a benchmark for investment decisions. Types of cost of capital. Cost of debt, interest paid on loans, after tax benefits. Cost of equity, return expected by shareholders. Weighted average cost of capital, WACC average cost considering both debt and equity. Example. If a company borrows money at 8% interest and equity investors expect 12% return, and the company uses 50% debt and 50% equity, WACC is equal to 0.5 by 8% plus 0.5 by 12% is equal to 4% plus 6% equals 10%. So, the company must earn at least 10% on new projects. Easy tip to remember. Cost of capital is equal to cost to buy money for business. If a project can't beat this cost, it's better not to invest. Simple and very important for smart decisions. Next unit 3. Long questions. First important long question is Net Present Value, NPV. Net Present Value, NPV, is one of the most important tools in capital budgeting. It helps you find out whether an investment or project will make money or not by calculating the current worth of all future cash flows generated by that project. What is NPV? NPV is the difference between the present value of cash inflows, money you expect to receive in future, and the present value of cash outflows, initial investment, and other costs. It shows how much value a project adds to the company today. If NPV is positive, it means the project is expected to earn more than the cost of capital, so it's a good investment. If NPV is negative, the project will lose money and should be avoided. Why NPV is important? It considers the time value of money. 100 rupee today is worth more than 100 rupee after a year. It accounts for all cash flows during the project life, making it very accurate. Helps compare projects of different sizes and durations. Guides companies to invest in projects that increase shareholder wealth. How to calculate NPV? 1. Estimate future cash inflows and outflows. 2. Decide a discount rate, usually cost of capital. 3. Calculate the present value of each cash flow. 4. Add all present values and subtract initial investment. Example. Imagine you invest 1 lakh rupees in a project that returns 30,000 rupees annually for 4 years. Assume the discount rate is 10%. Calculate present value, PV, of each 30,000 rupee cash inflow using formula. PV is equal to future cash flow, 1 plus Rn. Year 1 PV is equal to 30,000 divided by 1 plus 0.10, 1 is equal to 27,273 rupees. Year 2 PV is equal to 30,000 divided by 1 plus 0.10, 2 is equal to 24,793 rupees. Year 3 PV is equal to 30,000 divided by 1 plus 0.10, 3 is equal to 22,539 rupees. Year 4 PV is equal to 30,000 divided by 1 plus 0.10, 4 is equal to 20,490 rupees. Sum of PVs is equal to 95,095 rupees. NPV is equal to 95,095 rupees to 1 lakh rupees is equal to minus 4,905 rupees. Since NPV is negative, this project is not a good investment at 10% discount rate. Easy tip to remember. NPV is equal to today's value of future profits initial cost. Always pick projects with positive NPV because they add real value. It's the gold standard for investment decisions. Next important long question is 2. Internal rate of return IRR. Internal rate of return IRR is the rate at which the net present value NPV of a project becomes zero. In simple words, it's the break-even rate of return that a project gives. If the IRR is higher than the cost of capital, the project is profitable. Why is IRR important? IRR tells how much return a project will generate. It's very useful when comparing multiple projects. If IRR required return, accept the project. If IRR required return, reject the project. What does IRR show? It gives the maximum interest rate at which a company can invest in a project without losing money. It's the point where the project earns just enough to cover its cost. How to calculate IRR? IRR is calculated by trial and error or using software like Excel. It is the discount rate that makes NPV is equal to 0. In Excel, use the formula is equal to IRR, cash flows. Example. Suppose you invest 1 lakh rupees in a project that gives 30,000 rupees every year for 4 years. To find IRR, you try different discount rates in the NPV formula until you find the rate where NPV is equal to 0. Using Excel, IRR comes out to be about 17.1%. Now compare this IRR with the cost of capital, say 10%. Since 17.1% greater than 10%, the project is acceptable. Easy tip to remember. IRR is equal to investment's break-even return rate. If IRR is more than your required return, say yes. If IRR is less than required return, say no. It's like checking if your investment is strong enough to beat your target return. The higher the IRR, the better the project. Next important long question is 3. Cash flow in capital budgeting. In capital budgeting, cash flow means the actual money coming in and going out during a project's life. We use cash flows, not accounting profit, to evaluate whether an investment is worthwhile. Why focus on cash flow? Because cash is real money a business can use to pay salaries, buy material, or invest again. Profits shown in books may include non-cash items like depreciation, but cash flow shows what's actually earned or spent. Types of cash flows in capital budgeting. 1. Initial investment outflow. One-time cost at the start, buying machine, setup costs, etc. Example, buying equipment for 5 lakhs rupees. 2. Operating cash inflows. Yearly earnings from the project, after tax but adding back non-cash expenses like depreciation. Example, 1,50,000 rupee profit each year for 5 years. 3. Terminal year cash flow. Extra inflow in the final year, like salvage value or release of working capital. Example, selling equipment for 50,000 rupees in year 5. How to calculate operating cash flow, OCF? OCF is equal to net profit after tax plus depreciation. This is because depreciation is not actual cash outflow, so we add it back. Example, initial investment is equal to 2 lakhs rupees. Life is equal to 3 years. Yearly profit, after tax, is equal to 50,000 rupees. Depreciation is equal to 20,000 rupees. Terminal cash flow is equal to 30,000 rupees. Operating cash flow is equal to 50,000 rupees plus 20,000 rupees is equal to 70,000 rupee per year. Final year cash flow is equal to 70,000 rupees plus 30,000 rupees is equal to 1 lakh rupees. Now, use these to calculate NPV, IRR, payback, etc. Easy tip to remember. Cash flow is equal to real money moving in out. Focus on initial outflow, annual inflows, OCF, final year benefits. Cash flows are the heart of every capital budgeting decision. No cash, no project. Next important long question is 4. Advanced capital budgeting techniques. Advanced capital budgeting techniques are used when basic methods like payback period, NPV, or IRR are not enough. These methods help businesses make better investment decisions when projects are complex, risky, or involve uncertainty. Why use advanced techniques? Basic methods don't handle risk, flexibility, or uncertainty well. Real-world projects often change with time. Advanced tools give more accurate and practical results. Popular advanced techniques. 1. Adjusted present value, APV. It separates the value of the project from financing. APV is equal to NPV, as if fully equity financed, plus benefits of financing, like tax shield on interest. Useful when debt structure affects the project. 2. Real options approach. Gives you flexibility to make decisions after the project starts, like delaying, expanding, or abandoning a project. Example, investing in a new plant but waiting 1 year for market demand to grow. 3. Decision tree analysis. Breaks down decisions step by step with probabilities. Helps when there are multiple future outcomes. Example, launch a product, success or failure, expand or exit. 4. Sensitivity analysis. Tests how NPV or IRR changes when key inputs, like cost, revenue change. Helps identify the most sensitive factors. Example, what happens if sales fall by 10%? 5. Scenario analysis. Analyzes different possible future situations like best case, worst case, and normal case. Useful for projects in uncertain industries. Example in simple words. Imagine a company planning to launch a 10 lakh rupees project. It wants to check how interest on loans affects the value, APV. Delay decision by a year to watch market trends, real option. Use a decision tree to map outcomes, low demand versus high demand. Do sensitivity analysis to test NPV if raw material costs go up. Easy tip to remember. Advanced techniques is equal to smarter tools for real-world decisions. They help you plan for risk, uncertainty, and flexibility just like a chess player plans moves ahead. Next important long question is 5. Adjusted Present Value (APV) approach. Adjusted Present Value (APV) is an advanced method used to evaluate investment projects. It improves on the regular NPV method by separating the value of the project and the value of financing, like loans. What is APV? In simple words, APV is equal to base value of project, as if fully equity financed, plus financing benefits. It clearly shows how much value the project adds on its own, and how much extra value comes from taking a loan, like tax savings on interest. Why use APV? Useful when the company uses debt, loans, to finance the project. More accurate than normal NPV when debt levels change over time. Helps companies understand the true impact of borrowing. Formula. APV is equal to NPV, unlevered, plus present value of financing benefits. Unlevered NPV, NPV calculated assuming the project is funded only with equity, no loan. Financing benefits, mostly the tax shield on interest, since interest is tax deductible. Example, simple. Imagine a project. Initial investment is equal to 10 lakhs rupees. Cash inflows is equal to 3 lakhs rupee per year for 5 years. Discount rate, unlevered, is equal to 10%. Loan taken is equal to 6 lakhs rupees at 10% interest. Tax rate is equal to 30%. Step 1. Calculate unlevered NPV. Let's say unlevered NPV is equal to 1,50,000 rupees from normal NPV calculation using equity. Step 2. Calculate tax shield on interest. Annual interest is equal to 6 lakhs rupees times 10% is equal to 60,000 rupees. Tax saving is equal to 60,000 rupees times 30% is equal to 18,000 rupees. Present value of tax shield for 5 years is equal to 18,000 rupees times PV factor at 10% is equal to 18,000 rupees times 3.791 is equal to 68,238 rupees. Step 3. APV is equal to 1,50,000 rupees plus 68,238 rupees is equal to 2,18,238 rupees. Easy tip to remember. APV is equal to project value plus loan benefits. If you want to see the true value of a project, especially when taking a loan, use APV. It gives a clear picture of both project and financing impact. Next important long question is 6. Competing project risk using spreadsheets. When a company has two or more projects to choose from, it needs to compare them carefully. This is called competing projects. To make the best decision, we need to understand which project gives better returns and lower risk. Spreadsheets like Excel help us do this easily and accurately. Why compare projects using spreadsheets? Projects may have different costs, returns, and risk levels. Spreadsheets help you calculate NPV, IRR, payback, and other values quickly. You can also use charts and scenario analysis to understand the risk better. It helps in selecting the project that gives the best return with acceptable risk. Common tools in Excel for risk comparison. 1. NPV and IRR functions. Compare profitability of each project. 2. Data tables. See how NPV or IRR changes when inputs like sales or costs change. 3. Scenario analysis. Create best case, worst case, and most likely case for each project. 4. Standard deviation. Measure how risky each project is based on cash flow variation. 5. Graphs charts. Visualize project performance easily. Example. Imagine two competing projects. Project A, high return but high risk. Project B, moderate return but stable. In Excel, enter cash flows for both projects. Use is equal to NPV and is equal to IRR to find which project is more profitable. Use data tables to test how changes in revenue affect each project. Use is equal to stdev.p to find which project has more variation, more risk. Create a line chart comparing both project NPVs under different scenarios. Results. Project A has higher IRR but more risk, high standard deviation. Project B has lower IRR but stable returns. Depending on your risk appetite, you can now choose the better project. Easy tip to remember. Use Excel as your decision calculator. It shows you not only which project earns more, but also which is safer. More data, better decision.